Why model-based oil forecasts keep missing the mark. That and more on this week's weekly edition. What does Powell's comments in Jackson Hole mean to the oil and gas markets? But more importantly, what does it mean to investors? Federal Reserve Chair Powell's annual address at the Jackson Hole Economic Symposium is always a pivotal moment for the markets, and Friday was no different. His 2025 speech delivered on August 22nd was no exception. Titled, Michael, Monetary Policy and the Fed's Framework for Review. You can't buy this kind of entertainment. It did shake the market up, probably even more than Cracker Barrel, but let's keep going. Economic growth was decelerated around 1.2 in 2025, down from the previous year's pace. A notable update was revisions to the Fed longer run goals, moving away from the 2020 average inflation targeting. Michael, this is important. And why is it important for the oil and gas? Because it also means if he does go down 25 points in their next meeting, it means cheaper money for bigger oil companies when they go to try to do more drilling, because we need trillions of dollars just to meet normal decline curves. But what this also means is that for private investors, there will be everyone looking for, where am I going to get returns? This is critical.
Absolutely. I mean, I think this decision to move away from that 2020 guidance of, kind of what's been called average inflation targeting, now moving towards what they're kind of talking about, like a moving target or more flexible approach. The markets, as you said, interpreted this. Dow Jones was up 1.5 percentage points, S&P 500, and the NASDAQ were also up. I think you hit the nail on the head. I mean, from an oil and gas investing standpoint, the capital markets obviously are going to enjoy the fact that money's going to become cheaper. I mean, we're about to talk in our, at the end of this show about the potential Crescent Energy Vital merger. I mean, you're talking a $600 million market cap company with $2.8 billion of debt. I mean, that kind of gives you an idea of how much debt a lot of these large public companies who may not have exact core acreage need to continue to drill. And if President Trump and Secretary of Energy Chris Wright want to keep following through on this drill baby drill promise they had, they actually need looser capital markets. They need money to more easily flow into this. They need to ease the restrictions if they really want to drill baby drill and keep prices low. Do I think that's actually going to happen? Yeah, I mean, I think what you're going to probably see is a 25 basis points cut in December. I'm not going out on a limb saying that. Everyone is sort of saying that post Jerome Powell's speech, but I do think it's important to kind of buoy the oil and gas business from a capital market standpoint. Now, in a pricing structure, who knows what that does? I mean, we've sort of been testing that $60 lower bound. We hit it earlier in the week. We actually saw gains this week, as we'll talk a little bit about what that means for the markets later on in the finance segment. But, it's going to be very interesting. And I think the scarier notion is if they decide to delay cuts. I mean, now that we have this moving target, it really allows the Fed to do what they want. And, we could get in a big discussion about this idea of 2% inflation, trying to manage that as their goal all around. I mean, there's a lot that's wrong with that. Again, I do think for, investors in the oil and gas space, it's going to lead to possibly more drilling, but what that means relative.
The best thing they can do to manage inflation is stop printing money. Let's go to the next story here, Michael. Surging U.S. LNG export fuel growth in U.S. shale. But how does this impact investors and businesses? I had fun writing this one on our Substack, Michael. The United States has solidified itself, and I use that word solidified, as the world's leading exporter of liquefied natural gas. Michael, for the uneducated from Oklahoma State University, that is LNG. Surging exports driving unprecedented growth in shale gas production. As we keep going through 2025, this is reshaping the energy landscape. And I point to a couple key things in this article. Natural gas production has been more robust. Dry natural gas output reached a preliminary 3,327 billion cubic feet in May alone, equating to 107 BCF per day in a new high that underscores the strength sector. That's a big number. That's a lot of gas. That's more than Jerry Nadler combined. Let's go to the next one here. You take a look at it. EIA projects overall U.S. gas output to rise from 103 BCF in 2023 to around 113 BCF by 2030. We're going to need more than that in order to fuel the data centers and everything else that's coming around. In fact, the death of the Permian is overrated, and I've scheduled a meeting with Tricia Curtis, the CEO of Petro Nerds, to talk about the death of the Permian. Is peak oil here and a couple other key issues, and she is a top-notch person. She's one of my go-to people when I want to talk about oil and gas stuff. But here's where it gets really important, Michael, and that is the trade for molecules. The trade for molecules now means that people are starting to look at natural gas drilling separately than they used to be. And when you talk about drilling for oil, and oh, by the way, gas is a byproduct, we're also tracking the natural gas rigs remaining more stable in the rig counts. And when you start watching this trend, I look for trends, and we take a look at what's going on in the future. Businesses are going to start taking a look at, where do I put my business? I'm going to put my business where I can get natural gas. Where can I get business? And it's also going to be bringing up another one. I just interviewed Bill Mazzetti, and he is a cool cat from Rosden Data Center. Just turned that into the production team. He is working on the Stargate data center. This is a huge opportunity for businesses to take charge of their business up front, Michael.
No, absolutely. I mean, I think the other thing that's really interesting when it comes to the growth of LNG is the fact that, as we sit here, Stu, we're analyzing, 10 deals a month, 15 deals a month, and talk about trends. The Permian is getting gassier over time. The gas oil ratio is becoming way higher than it was 10 years ago. I mean, you used to think about GORs in the low 600s. You're now seeing them over 1,000 when it comes to the amount of gas. And so what does that mean? It means that, we're not depleting not depleting the Permian, but not to get all reservoir engineering on us, but we're lowering the bubble point, which forces more gas to come out of solution. Well, what does that mean? It means we're going to have excess amounts of this LNG as we continue to drill up the Permian, as it still is one of the more economic places. So if you're thinking about where as an investor possibly to put long-term capital, LNG makes a great spot. Now, the interesting part is I don't think the value is going to accrue to the drillers, because there's going to be an excess amount of LNG that's going to drive prices down. I think where the value is going to accrue is a lot of these export facilities. The issue with that is, an investor, you need billions of dollars. You can't come in, unfortunately, they're not letting the individual accredited investor into this. You need to be more of an institution to get into this. But if you are an institution looking to bet on energy and want to get involved in the energy business, LNG exports, in my opinion, is where the value is going to accrue as this shift happens.
Oh, I couldn't agree more. ERCOT project cancellation reached a record in Q2 of 2025. What is next? I want to call attention, Michael, to this picture that is standing there with the windmills where the winds, they're not blowing. This was taken by this character called Stuart Turley as he was driving out of Abilene on Saturday morning. And it was actually a very interesting to see all of these windmills in West Texas not moving. In the second quarter of 2025, the ERCOT witnessed an unprecedented surge in project cancellations, marking a pivotal moment in the state's energy landscape, with approximately 16 gigawatts of power generation scrapped. Oops. I'll tell you, we take a look at many of these projects. Only 9% of the projects in ERCOT queue are projected to come online after 2028, signaling a bottleneck. Oops. This has led to $14 billion, over $14 billion in energy cancellations by mid-2025. This is pretty big stuff. Take a look at these cancellations in this chart, Michael. Lots of them happening right now.
Yeah, and a lot of that I think has to do with this shift away from incentivizing more stable streams of energy and this shift towards renewables. Now, I think things are swinging back a little bit, but again, as we predicted after the big beautiful bill, we're going to see a surge of projects being staked so that they can be eligible for the tax credit, and then it'll eventually roll over, and I think you'll get back to natural gas. I think everybody's talking about nuclear right now when it comes to some of the future huge base load demand. So I think it'll be really interesting where it comes there. I mean, that's a big number, though. You said, Stu, 22 billion of cancellations of clean energy projects.
And the argument, Michael, that's out there right now is that you can put a wind farm and a solar farm faster than you can do natural gas or nuclear. But the problem is, for each nameplate of a megawatt, you've got to have 180 megawatt. I mean, you got to have 180 times the megawatt. So even though you can bring a megawatt online for a solar farm, you got to add 180 on top of that, because the math don't math up, as we say in Texas.
No, the math ain't mathing.
Math ain't mathing. The true cost of renewable energy and the impact on consumers' electrical bills. But what does the EU, UK, and ERCOT all have in common? This is a story out of the Energy Newsbeat Substack. In the global race toward net zero emissions, renewable energy sources like wind and solar are often touted as the affordable path to a sustainable future. Governments, including those in the EU, the United Kingdom, and the United States, have implemented big ambitions, but rut-row net zero policies in the EU and UK. Let's talk about promises versus reality. The targets for 42.5% renewable energy in the overall mix by 2030 and significant reductions in greenhouse gases ain't going to happen. What happens is net zero equals deindustrialization. Just ask Germany, just ask New York, just ask New Jersey, California. But here's where it gets dicey. In this article on Substack, I wrote this part reviewing Dieter Helm's analysis, systems cost, and the renewables. This was an outstanding article that I went and analyzed it and took a summary. Helm argues that while the levelized cost, the LCOE for wind and solar has dropped, this metric ignores broader system costs, intermittency, the fact that renewables generate only when the wind blows or the sun shines. But yet what he missed was what Meredith Angwin, from the author of Shorting the Grid, talked to me about a while ago, and I brought up that point. Let's take ERCOT for an example. ERCOT is about 90 gigawatts that they need in order to supply power on the grid. That 90 gigawatts, though, they'd have 180 gigawatts. Of that 180 gigawatts, they could do with a lot less using the old standard of coal, natural gas, and nuclear, of just adding 20% just in case you had an outage, if you needed downtime to repair maintenance. But now when you take a look at 100 and 200% more power, that cost is never calculated into the consumer price front, and neither is the land reclamation, and that is not being talked about, and it was missed in his article. That's why I added it into my article here on this. So go to theenergynewsbeat.substack.com and check it out. Why is model-based oil forecast keep missing the mark? This is an outstanding story from oilprice.com, Irina Slav. I absolutely love Irina Slav and her sense of humor. Her knowledge is top notch. Let's go through the three top bullet points and then we'll go through the story. Many oil price forecasts, particularly those from the International Energy Agency and net zero organizations, consistently predict a glut in ignoring contradictory data or using flawed computer models. Yeah, we've been saying that for quite a while. Despite these forecasts, global oil demand continues to grow. Sorry about that. Prices frequently jump in response to threats on supply, indicating a tighter market than models suggest. Listen to this. Reliable indicators of oil demand and supply are found in physical market data, which often leads to forecasting bodies to reverse their projections and call for more oil investments. I want to give Chris Wright a shout out at the Department of Energy and the EIA in the United States. They have gotten better at not politicizing their data, unlike the foreign, the international, or the IEA is about as political as you possibly can get. Brent crude is trading about $67 a barrel, and WTI, West Texas Intermediate, is about 65. Not because the world's consuming less oil than 3 years ago when crude shot up over the $100. Oil demand has grown steadily since the 2020 slump caused by the pandemic. The only reason these forecasters, and most notably the IEA, are predicting a glut is because that is what fits their models. And she is spot on. Irina hit it out of the park because that's what I've been saying. We need trillions of dollars just to invest in meeting normal decline curves. That has not been happening. So if we sit back and take a look at whether or not it's just normal decline curves, that means demand has got to be there. And another major thing is what happens if the Russian sanctions are lifted? If Zelensky can actually understand that he needs to be the big boy in the room, get a new tailor and not from some child's wardrobe like he showed up at the White House, and actually end the war, give Russia the Crimea that these Russian bases have been at for 1 billion years, and then go ahead and then allocate that out there. Zelensky needs to end the war. If Russia ends the war and sanctions are lifted, prices are going to go up because Russia is pretty well maxed out on their EMP company's ability to increase their production. They've been able to avoid sanctions by the use of the dark fleet. They have a ballpark number of 700 tankers, and they are quite capable of keeping their oil flowing. However, that being said, they have a limited supply unless American companies could help them out and get going again. And then I think energy as an export, as a service, would help Secretary Chris Wright be energy dominant by exporting services. But anyway, she brings up some other great points. Last week, prices tanked after the meeting between the presidents of Russia and the United States as I was going in. Then the EU and Zelensky took the meeting home, and the prospects of peace began to evaporate, only to be replaced by the prospect of more sanctions on Moscow. Irina has coined the phrase, sanctions don't work as intended, and they will still mean that Russia will be able to sell all he can produce, but he's been limited in putting money back into production because he's funding the war. So he's not capable of putting out a lot and flooding the market as people are saying, oh, Russia's going to flood the market. Not going to happen. Anyway, outstanding job, Irina Slav over at oilprice.com. Also, subscribe to Irina Slav on her Substack as well, too.